The last time we were together, we talked about the iceberg effect and how what was going on below the line was devastating to clients because they don't see it, and many financial planners are not addressing it. But we have been addressing it, and we're talking about the individual problems. We call it the junk drawer. But I wanted to talk today, Matt. Now, bring Matt in. Matt is with us again today, and I wanted to talk, Matt, about. I did a short on the 401k being used as a cash machine, and another one about life insurance that people are putting money into life insurance in record amounts over the last couple of years. So we can get a flavor that they're just scared. They're looking to protect their money and not lose it. And I immediately thought of the model and the areas that you talk about in the model of protection, savings, and growth. So I'd like to have you explain to people why they're moving their money into these safe areas and the benefits they get when they do it.
Yeah, well, I mean, during times when the economic stress is on families, when inflation's high, or if the market is in the ups and downs or the ebb and flows that we've seen over the past couple of years, people tend to focus on some of their anxieties, and that anxiety is how do I protect my family in the event that something happens to me, or how can I protect my wealth? So that's the purpose on why we break down the model into three different components. One is the protection phase, then we have the savings phase, and then we have the growth. So if you can imagine people over the past 19 years, because the market has done so well and they haven't had any attraction to anything that, interest rates were at historical lows. So they had nowhere of running to put their money in safe havens. Okay. So today, with interest rates being at least attractive, people can start looking at non-traditional products like permanent life insurance or fixed annuities. So while Steve's putting up the model, as when you see the model, you'll see that each section has 9 boxes. You have the protection box, the savings, and the growth. And one thing that we do well, as we talked about in our last episode, is we take people's junk drawer and we organize it. And our goal is to make sure that there is continuity between each one of these boxes. You'll hear the terminology that we use, that it's a micro. Each one of those boxes, like P1, P2, P3, is a micro look at what you're doing in your protection. And what we put it on is we put it on a macro approach so that we can try to map out some of the synergies between those products. So, like I use the example, especially in the 9 boxes in the protection side, is that, one of the most underserved products in our industry is disability insurance. People have a major concern with it. And we had a customer that we were able to identify some gaps in his business, that God forbid if he got disabled, that his business was going to still run while he was getting an income from his disability insurance. And we were successful because that individual ended up having a disability and was able to save his practice. Now he's back running his practice and drawing an income back out of it. But if you look at that drawer, to show you that the junk drawer effect is, if you're just looking at disability, you may call a disability provider and say, listen, I make X amount of dollars. And what they'll do is sometimes you get it through work, where you'll get a long-term disability, and they'll give you, 66% of your income, God forbid, if you become disabled and can't work, if you become too sick or too hurt to go to work. But there are other areas that you can gain some coverage on that people don't really consider, because they're stuck in that junk drawer where they're buying disability insurance to just protect their income. But if you look at P1 in the auto insurance side of it, let's say, for example, you were able to put on their loss of wages. It's a cheap coverage, might be able to get you anywhere from $1,500 to $2,500 a month, that if you were in an automobile accident, okay, and were injured and couldn't go to work, your auto insurance could give you a short-term benefit of $1,500 to, let's say, $2,500 a month while you're waiting for your your grace period in your disability to kick in for a long-term disability. You also
Right.
have ways to protect your savings, like if you go down in P9. We talked last week about, a great way to protect your savings there is you can put a waiver of premium protection. So if you're putting $3,000 a year away into your life insurance, and the purpose is in 18 years that you're going to pull that money out to pay for your kids' education, okay? If you become too hurt to work, and you make 100 grand a year, your disability might be able to get you $66,000 a year. That may cover your bills, but it's not necessarily going to cover any extra money that you were saving outside, like into your 401k. So some disability policies will have coverage in there that they'll provide you with the contributions into your 401k as well. But the life insurance side of it, with the waiver of premium, if you're putting that $3,000 a year away, it's self-completing. God forbid if anything happens to you, the death benefit's there. That's the main purpose of the life insurance. But again, there's 3 boxes there that can address the concerns of if you become too sick or too hurt to go to work. If you're hurt in an automobile accident, you could get coverage there. We also recommend that everybody examine their disability coverage, whether they're self-employed or whether they have options to purchase that product through their employment benefits package. And then also we put a strong recommendation that life insurance can help protect some of your savings that's going into that policy with waiver of premium.
So when I saw that article that said that life insurance premiums are are being deposited record numbers over the last 2 years, can I assume that people are just scared of the markets and they need safety and they're learning about the fact that if you put your money in life insurance that you get a lot of benefits but you preserve your money?
Mhm.
Is that a good way of looking at why they're doing it?
It's an accurate statement that if they're presented with the option. I mean, life insurance is the most misunderstood product out there because of the financial institutions' tendencies to sell products versus solutions. Okay. So I feel that most of my customers are more, I guess, accepting of outside non traditional recommendations because of their, and I think it's, I don't know, I think it's a little bit of fear, but it's also they're sick of the controversy of whether the market's going to go into a correction or not. So over the past 3 years since 2002, all we've heard about is, we're going to have a soft landing or a hard landing with the inflation numbers, but the market's on a boom right now. So I think people are afraid that they don't understand whether we're going to have a soft landing or a hard landing, and they're looking and accepting more non-traditional products that can give them the ability to meet their objectives that they probably weren't presented to in the past.
So the financial institutions are still out with products, but people are recognizing the fact that those products are not as safe. And I guess we got a lot of people reaching retirement age or getting close to it, and they're worried.
Mm-hmm.
So they're learning uh, to be safe, and they're playing financial defense. If we look at the model that we had up there, if you were to draw a line across the bottom of the model, right in the center of it, right across the middle of the orange, above the line, above that line is financial defense, and below the line is financial offense. So people have been playing financial offense for many years, and all of a sudden a problem occurs, which is up in the purple boxes, and they have to address it. They have a major expense or whatever, and they have to erode away their offense to support the defense. So what we're saying is support the defense and protect everything. You'll still get growth in the defense. It won't be as wild as you're getting down in financial offense, but you'll actually get growth in defense, but you'll get the protection too. Like we have a lot of clients that have money in annuities that gives them a defensive strategy because it's not going to get lost. Doesn't have death benefit to it, but it's there, and if the markets go down, they don't lose anything.
Yeah, well, I mean, when you look at offense and defense, so if you draw it, defense, we set up a game. We set the rule book to the game. Okay. And if you follow the model that we put in there, our objective is to get maximum protection, maximum efficiencies, maximum effectiveness of your money, and maximum output. Maximum output doesn't necessarily mean that you have to get a 25% rate of return on your money. It's a tax efficiency way. I mean, we examine again below the line or below the water on the iceberg. We take into consideration propensity to consume. Okay. So, like you talked about that article in the Wall Street Journal about people accessing their 401ks like a cash machine, like it's a Mac machine. Well, that goes against the proper planning on why you should be putting it into the 401k. So everybody is programmed that as soon as they're eligible for a 401k is to just unload as much money into that. Well, you have to look at the benefits of it. And the benefit is that you get the tax deduction today. That's the first primary concern, is that it's going to lower your taxes today. Okay. The next benefit is that it grows tax deferred. But if you don't look into the consequence, the liability that every dollar is going to be taxable in the future, then you could be set up for a slight issue in the future or a major problem. So I sit down with customers every week, and they may have $2 to $3 million in their 401k. But what they don't realize is there's a tax liability on that as well. So when you allow the propensity to consume money and you take $20, $30, $40,000 out of your 401k, okay, you have now depleted that in the future. Other products like permanent life insurance will allow you that if you had the discretionary income and were able to put it in there, that you could access that money without hurting the growth of that. So your money, your cash values will still grow even though that you've accessed that money. So what it does, again, it's giving you maximum protection in the death benefit and waiver of premium on your savings, but it also gives you efficiencies in the fact that if there is a disruption in your financial plan, you can tap into that without hitting its long-term range goal. And that's what people miss out on. In today's world, there is a tremendous amount of wealth going from one generation to another. And they're finding out that there is needs for insurance in later years. And that's why there is a large number of policies being written, because retirees have two major concerns. Will I outlive my money? And how do I not spend all my money so that my heirs can receive it? Well, your plan has to take that into consideration. By using products like annuities, we can give people guaranteed income streams for life. So you can take the reverse strategy of life insurance. So life insurance is where you have a concern that if you die, you have a cash need to take care of yourself and your family. So you're giving the insurance company a premium to pay for, God forbid, if anything happens to you, that a large cash comes into a cash influx comes into your plan. Okay. An annuity is the reverse side of it, is where that you have a large number where you have a large bucket of money and you want to protect the fact that you don't want to run out of that. So an annuity can give you what our generation, which my generation doesn't have, and that's the pension-like income for the future. So a lot of our clients that we're working with is we're again looking at products that can solve multiple needs and give you efficiencies and effectiveness with maximum output. Okay. And if you're not examining the protection inside of that, then again, you're going to set yourself up for a snag in your financial plan in the future. So I think that article was probably saying that there are people that are worried about the transfer of wealth, and life insurance is a great way to transfer wealth to a family. Okay. In my particular situation, my goal is to set my kids up, if God forbid, if anything happens to me, that they'll be taken care of. Okay. I brought them into this world and it's my job to make their lives better. Okay. But the most effective way for me to transfer my wealth to them is through life insurance, because it goes to the family beneficiary designation so that you don't have to worry about the probate fees in your estate, but it also gives them a tax-free benefit. So rather than my son or daughter inheriting my $1 million IRA, that they have to, once they inherit it, they have to take it out over 10 years, creating a tax liability on them, especially if they're high wage earners or if they're successful in their wages. Okay. So I would rather utilize my spend down process of my 401k or my IRAs and consume it to me because of the tax liability, and then leave them or bestow to them the death benefits because it goes to them tax free. So I think people are being more wise on that. Listen, since the law has changed that you must take out an inherited IRA over 10 years, that there are more efficient and effective ways to leave your wealth to a second generation. And that is an increase in the estate planning that is backed by a lot of life insurance moves. And most people will listen to these gurus that say you don't need life insurance when you're retired. And they are completely wrong in the fact that the life insurance is a key component because it allows you to alleviate the two biggest fears: outliving your money and giving an inheritance to your second generation.
Yeah, and it goes back to addressing issues that are relevant instead of addressing issues uh, that are just centered around a sale. And people need advice, but they need structured advice. And our model gives structured advice because we can actually see it, and then we can simulate the future and do it before it happens, and then see whether it's viable or not. Too many times people are shooting from the hip. The whole thing is shooting from the hip. They don't know what's going to happen in the future. So you could pick a reasonable uh, focus of what you want things to look like later on and project them out. And our model does that. It simulates it, which is very powerful because you could do what if scenarios, but people can actually see what's going to happen.
The problem with people today is they've been conditioned to think about the only concern that they should have is achieving the highest rate of return on their money. Okay. And everybody goes through the Monte Carlo charts that if you put $1,000 a month away and you get a 10% rate of return, you're going to have this huge bucket. Again, top of the iceberg. Beautiful. You see the water, the blue water, and then you see this magnificent white ice out there, and it looks great. But what they're not analyzing is what's underneath of that, and that's the erosion through taxes, the propensity to consume. And the one thing that our model does embrace that most financial plans don't is the consistent change that the environment does. The one thing that we embrace is we know that tomorrow is going to be different than today. And if you don't have flexibility in your plan, okay, you're going to be set up to have to make adjustments that could cost you money in the future. And that's what kills me when people make these blanket statements like, you should do this, or, buy term and invest the difference, or, the only way to save for college is a 529 plan, because all those products are built for the right reason. But if you don't examine the potential of change and expect it to come up and use the innovation of products today, like I've been in the business for 30 years, and one of the luxuries that I've been able to see is our products become more sophisticated and more innovative every year. Okay. We have customers that take money out of their 401k, and we're able to give them guaranteed pension-like income for the rest of their life. Think about that. My grandfather retired because a company put away for him so that when he retired at 65 years of age, that he was giving an income. Okay. It wasn't, okay, take me off the hook. I don't want to put away with you. I'm going to put these defined contribution plans in there where you put your money and I'll give you a match. And then all the onus is on you. And if not handled properly, again, you lead to the two biggest fears, and I'll lead to one is How do I solve the concern of me outliving my money? So product innovation is what can give you that junk drawer organization. Like there are products out there, there are annuities, there are life insurance that take into consideration long-term care, a huge concern for people today. Okay. 20 years ago, their only viable option was to purchase long-term care insurance, which is pretty darn expensive. And people were intimidated with it because the premiums could be $5,000 to $6,000 a year. And if you don't go into a nursing home, it's a true cost, and there's a lost opportunity cost to that. Well, now annuities put it in there. Life insurance gives it to you. So again, the junk drawer makes people's plan inefficient, okay? Not effective because they're not maximizing their efficiencies through product innovation. And that's the key component that what we drive, because we are agnostic to products. We don't endorse any one company. We don't endorse any one product. We put the money on the model. We go through a problem identification where here are the problems. And it starts out with your auto insurance. Okay. People are, I mean, if you just watch the news or listen to the radio, there's at least 7 points in a day that you're talked about, in that the only thing you should be looking to is switch from one carrier to another to save $347. Savings is important, but maximum protection is more important, and we're being conditioned to not worry about that. It's almost like the industry doesn't want to take on the accountability of, hey, listen, our job is to protect you in that facet. I use the scenario a lot that, you know, everybody loves plastic, okay? And plastic manufacturers manufacture the plastic, which is, hurting our environment. And it's used in masses, right? But that industry transitioned the concern of the environmental damage to us. They forced us to go through recycling. Okay. They forced us to take the onus on recycling, not them. And it's almost like that industry passed the buck to the consumer. Well, when I look at somebody's plan, I take the same approach there. That, you know what, the industry is putting more onus on you than accepting the risk themselves in some situations. Term insurance is a perfect example. I think the statistic with LIMRA is only 2% of term insurance bought is a death benefit ever paid out, because the industry knows that the premiums are going to go up when you're most likely going to use it, and it's going to be cost prohibitive. You're not going to pay a large premium because you're not going to want to pay it, and the death benefit's going to be dropped. So now not only did you lose all the premiums that you put in there, but you also lost the economic benefit of the death benefit that your family should have received. What we make sure is that when you buy life insurance, maybe not all of it, but a large portion of that, we're going to put the responsibility on that insurance company, that when you're most likely going to die, that death benefit, that economic benefit that you paid for 30 to 35 years, okay, is going to come true for your family. And most people don't consider that. They just look at, well, it's a smaller premium, and it's cheap. Well, in all reality, it's a very expensive product when you analyze the lost opportunity cost of all the premiums that you put in, and then you never get that death benefit. At least in permanent life insurance, yeah, it's more of a larger premium coming out, but it's built for sound protection with other benefits that have living benefits in there. There's a cash value. But we know one thing, that the life insurance company is on the hook that when you die, whether it be 62 or 82, that death benefit's coming into your family.
Sure. People don't understand that term insurance is cheap when you're young because you're not going to die. There's a slimmer chance of you dying when you're young than when you're getting older. At 65 or 70, try to buy it. It's outrageous because what's happening? You're getting close to dying. And I've had clients who've had term insurance, and all of a sudden at age 70, it's gone. And what can they do? And people keep saying, and it frustrates me because, well, I don't need it later on. It's tax-free money to your heirs. And if you start at a younger age, there's no cost.
Hmm.
is growth in it,
Yep.
but it's
Well,
tax-free money at death.
yes.
Your house isn't.
And I think that the one thing that especially with I just talked to two young customers last week, and their recommendation is they were to buy term insurance. They couldn't afford the whole life premium. There was no discretionary income in there. But one of the things that I take into consideration is you just don't go out there, and I use the same thing with the auto and car insurance, the car insurance and homeowners insurance. You don't just look at the premium. You look at the fact that is there a conversion option in there? And what the conversion option does is allows you to supplement or bring the death benefit need into the household, which is the most important thing. Okay, the most important thing for us to do is maximum protection. So if the maximum protection has to be term insurance because there's no discretionary income, there's no affordability for them to pay that product. Okay, to pay for that, then what we examine is how do you buy a term product that allows you the flexibility to convert it to a permanent policy in future years. So as you start to make more money, or let's say, for example, you got into some student debt and some credit card debt because things didn't go well after school. We're managing the debt side of it, getting out of that. But once the discretionary income and the debt service is off and there's more savings, now you don't have to go through a medical anymore. You can just convert a piece or all of that to permanent life insurance that will give you maximum protection through the most important years, and that's when you're most likely to pass away. And that benefit gives people the option to do open up doors that if something does happen, that they have a nugget of money over here that they can go borrow against it. They can do reverse mortgages on their property. They can
Mhm.
afford to do certain things because that death benefit is a fixed product in their plan, not a temporary solution.
Right. We should pick up on this next time. We'll talk about the model, and we've really talked about this a lot, but we need to start bringing, I think, a little more specifics to it. But what you're talking about with 401k, what you're talking about really is financial defense and offense. So we should probably stay on that topic and just show people the financial defense in the model and why they need to make sure that's perfect before they go into financial offense. So maybe next week. Yeah. I want to thank you all for coming and listening. We're blessed that you're here, and just like to have you like and subscribe and uh, sign up. Ring the bell. Got to have a ring the bell, and
Give us the
let us.
opportunity to solve your concerns, and that's
Right,
and that's what we do is we help people navigate the financial world by alleviating the bottom of the line iceberg effects and bring
right.
sound solutions that they can put their head at night after working hard and saving their hard-earned money, that we can take care and smooth the obstacles out throughout the journey to retirement.